So that general 4% rule, hey, that general $1 million to retire. This is the chapter and the topic where that all gets blown out. It's not valid. Welcome back. We are here in the 10 fears of retirement. Now listen, I am your host, your author. Hopefully everything that you're getting out of this. My name is Alexander Pushman. I'm enjoying this. I hope you're getting a ton from it. I love doing this. The first thing I always like to start with is we're in chapter 7. So we're going to be talking about market risk and your investment options or investment choices. This is one of the most complicated pertaining to it changes like the wind blows, right? I compare the market. I grew up here in Michigan, and I compare it to the season change, right? What do we love about the season change? Well, hey, you get a little bit of everything, right? In the summer, it's beautiful. The winter, it's cold and quite the opposite. And the stock market is very similar to that. On a conceptual basis, think about it like this. A lot of financial advisors and experts will say, hey, we're long-term investors. And I would agree with that. I'm a long-term investor. However, that doesn't mean we're always using the exact same investment choices. My example, if interest rates are going up, it's probably not a good idea to sit in bonds for your safe money. Again, there's exceptions to that rule. I'm not saying every single bond, but the basic principle of bonds, which we'll talk about, is when interest rates go up, the bond environment will lose money. So, it's really important that we identify what are good investments based on different market conditions. Every single family is unique. One of the things I talk about in this chapter is your tolerance for risk. Hey, how much longer do you have before you need to draw income, right? What's the average lifespan or what are your medical situations to where, hey, how much longer you have to live? So these are some of the things we're going to dive into that are really important for you to understand, but keep this in mind. Of all the chapters we've talked about, of every fear that I've discussed thus far, this is probably the most unique pertaining to it has to be very, very specific and tailored to you and your family's needs. Sign up with us, which the link should be right here on this podcast. So I'll jump into the meat and potatoes. So let's start with this. When we talk about market risk, I've already kind of talked about the big picture of it. It's kind of similar to the seasons changing. There's different investments for different seasons. And I'll kind of come to some more recent times, right? Let's talk about 2020. It's March of 2020, and all of a sudden, something that I watch close is something called the VIX index. What the VIX index is, with keeping it pretty high level and not boring you to sleep, is the VIX index monitors options trading. And what we call it in the business is the fear index. When people start getting scared, all of a sudden you'll see this VIX index, VIX, start going up. People are getting scared. They're putting options to hedge their accounts. So whenever we see this VIX index going up, it's usually a good indicator that people are getting scared. And usually when people get scared or are fearful, that's not a good thing for the stock market and or our investments. So it's 2020, it's March, and all of a sudden this pandemic, this COVID-19 thing starts popping up and people are getting worried. Interesting, the last time we saw the VIX index get as high as it did was, guess what? 2008, when we had that real estate bubble pop. So it was really interesting because we see this VIX index go up, aka fear. People are getting scared almost to the exact same level as it was in 2008, which I know most retirees, most boomers remember 08 because that was a year we lost a lot of money, right? Our 401ks, our IRAs, our investments really took a hit. So 2020, it's March. All of a sudden, people start getting worried about this COVID-19 thing. And then we had a very unique scenario take place. We had a lot of funding come into the stock market through the World Bank, the United States government, China, some other areas where it basically put the market on stilts. And then we saw, boom, this massive jump. So we see this huge drop, people get scared, and then boom, this huge jump comes. That's not necessarily normal. Usually when we see these 20, 30% declines, it can take 1, 2, 3 years to come back. Well, 2020 was really unique because it came right back in, the next 3 to 4 months. So, it's impossible. And I'd say probably, the last 4 or 5 years here have been some of the most unique market years because we're dealing with a global economy. We are dealing with technology where, for example, Elon Musk, right, the owner of Tesla, at least at the time when I'm making this, he sends out a tweet or the X app that he has now that he bought. But he sends one of those quick messages out and you could see Tesla go up or down based on what he's saying. Technology is making things move quick. Annual reports. It's no longer in the situation where you sit down, you look at an annual report and it's digested over, 2-3 weeks. And then we see the stock start moving or the index move. It's happening really fast. So a global economy has absolutely changed the pace and rate at which we see the stock market move. The news, whether we like it or not, whether you're a Fox or a CNN or an independent news source, we see influence from media and politics probably more than we ever have, which I don't want to say is a good thing, but it is what it is. So we're in this unique space where information is moving faster than it ever has. We see ups and downs quicker than we historically have. And it's important that when you look at your investments, whether it be your 401k, your 403b, your non-qualified dollars, your Roth dollars, which as you know is my favorite, the Roth, that you understand what you're in, you understand the risk that's associated with it, but more importantly, you understand what all of your options are. That's one of the things I really lean into with the clients and families I work with. It's not necessarily say, hey, as a financial advisor, I should just tell you what to do and you should trust me blindly. I have those type of clients. And they say, Alex, this isn't really my thing. I just want you to help me. But I think education's the key. And so that's one of the things I really lean into when I do my review with families, when I do my second opinions, which is what I was kind of talking about in the beginning of this podcast. If you want to be educated, it's a great time to reach out. So how I look at it is understand your options. Risk, moderate risk, safety, or conservative, and then make informed choices. That is the way this should look. So I go back to 2020, we get this big bounce down and then it shoots back up, right? And everybody's happy. 2021, another good year for the most part. And then we get to 2022. Unique year. Why? Well, let's think about it. It's December and December of 2021, and Powell from the Fed comes out and says, hey, we're going to raise interest rates 6 times. Now, for an uneducated investor, they don't really know how that's going to impact their portfolio or their investments. But what I know is when somebody says, hey, we're going to raise interest rates 6 times. Now, do we know if the government and the Fed is actually going to do exactly what they say? No, it might be a little bit different. It might change, but they're giving us leading and or indication of what certain things should do based on economics 101. Hey, we're going to raise interest rates 6 times. What they basically told me is bonds were going to lose a lot of money in 2022. And then we started kind of going down the line of things that influence the stock market, whether it's the US or global. Hey, we then shortly after into 2022 start having a conflict between Ukraine and Russia, probably something that's going to impact the world. So really early on, and I don't want to say I got it right and I nailed it. That's not what I'm saying. But really early on from December of 2021, I had a good feeling that it didn't look great going into 2022 based on the interest rates, based on the hypotheticals of what was going to happen in the bond market. And then you start throwing global conflict in. It usually doesn't land well out of the gate, especially when it's a powerhouse like a Russia and Ukraine, what we call the breadbasket of Europe, right? So there were some things heading into 2020 I wasn't very bullish on. And so you have to understand when they give you information, what to do with that information. So let me bring it down to a level that you can apply to your accounts. If you are somebody who has those retirement target funds, hey, target 2020, 2030, 2050, and it's got a year on it. How those work is they're really just introducing more and more bonds, stable value funds, bonds, more conservative investments, the closer you get to that year. So if you're somebody who's sitting in, again, every different company is a little bit different, whether you're ProShares, Invesco, Vanguard, whatever you're in, if you're in something that's like a 2020 or a 2025, the odds are you are on a higher ratio of having bonds. They're trying to create more safety or less risk inside of that portfolio. So, hey, Alex, I got 100% of my 401k or my 403b, and it's in my Vanguard 2020. Odds are you're probably somewhere in the neighborhood between a 70 and 80% of that holding bonds, and the rest is going to be market-based, equity-based, S&P 500, maybe it's some NASDAQ, maybe it's some value, mid-cap, large cap, all that good stuff. So understand when you have these target funds, you have a majority of bonds, most likely, and if interest rates then go up, you still have risk to lose money. So you need to be connecting the dots of, hey, most of my money's in one of these target funds. It's a 2020, it's a 2025. And if interest rates are going to go up, I still have risk to lose money, not even talking about the stock market, just talking about your bond relationship. So these are the type of educational pieces that I like to talk about with families of not necessarily you make changes and not necessarily it's good or bad, but that you can make an informed choice based on the information of the economy and the world on, hey, is this the best stuff to be in? Or do I have an option that might be better? It was funny. I on a monthly basis, I get this report and it basically stack ranks what the best investments are over the last, year or 5 years or whatever it is. And it was funny because in 2022, one of the best investments you could have had, kind of on like the 10 sectors they identify, was cash, right? Why? Well, cash didn't lose any money, and money markets were doing pretty good in 2022 because they raised interest rates. So now you're getting a higher rate on your money, and or cash money markets. You're making some money. You're not losing, and that was kind of the key to 2022. So my point to this whole thing with risk and understanding your choices of how much risk you should or shouldn't be taking is really going to be unique to you, your family, how much money you need. But what I will tell you is that old school, hey, let's never make changes. I'm a long-term investor. You don't want to make a change when the market's going up or down. I don't necessarily agree with that for the simple fact that active management, understanding what your investment choices are today, if there's something better that can accomplish the same goal, that's the important information you need to be seeking from your financial experts, your financial planner, whomever that may be in your life. And again, that's kind of the conversations I'm having with families on, hey, what investments should you be looking at? What do I like for you? What's a yes and what's a no? And it's usually that simple. What I tell you in my professional recommendation, what you should do and shouldn't do based on the current climate of the economy and the stock market. So risk is really important. There's a couple different ways I spin risk pertaining to helping people connect the dots. The first one is this. Hey, how much money are you willing to lose? In 1 year, what's the dollar figure that you're comfortable losing? Most of the time, the answer is nothing. I do not want to lose, right? Amen to that. But this is also what I've identified. I've done this long enough where if somebody has a tough go, 3 months, 6 months, a year, whatever the time frame we're talking about. When I sit down with a family and they may have lost money in a certain account or a certain fund that we have and own and are investing in, I very rarely will have somebody come in and say, Alex, I lost 3%. I'm really mad. It doesn't work that way. They use a dollar figure. Alex, I lost $60,000. It's very personal, right? This is your life savings. It's the same thing with me. When I'm looking at my accounts, now I do this for a living, so I'm probably a biased opinion, but when I look at my account, I'm saying, okay, what's the percent, but what's the dollar figure? And how's that land with me in my spirit? So, I can always ask you, hey, what's your risk tolerance, 0 to 10? And that's the other one I was going to use. It's really easy to understand. Hey, if you're in 10, you're in a cryptocurrency, and there's a lot of risk there, hypothetically, or you're a 0, and you're sitting in cash in the bank or a money market, right? Or an annuity. So my point being is there's two ways you should frame this is number one, establish, hey, what's the number that you're comfortable losing in a year? That should help guide you on where you land on that 0 to 10 scale. Again, as a best practice, I hate to generalize, but let's just do it. As a best practice, a lot of retirees, they might say, hey, Alex, I'm okay being risky with a portion, keyword portion, but I do want to have some safety built in there. because now I'm going to be needing to draw on these accounts. I'm going to be taking money out for retirement to supplement my Social Security and or a pension if I'm lucky to have one. So, hey, maybe I'm a 60% risk, 40% want safe. Hey, you'd probably be a 5.5, or maybe a max 6 out of 10 type of investor. So just kind of helping you walk through where you should be looking at. Best practices, and again, everybody's different. I joke around and I talk about me and my wife. I'm 40 years old as of today, and my wife, she's about 6.5 years younger than me. But what's funny is she's in her, kind of early to mid 30s, and she's one of the more conservative investors I know. I'm very aggressive. I do this for a living. I'm well educated on the subjects. I'm okay taking some risk because I know I still have some work ahead of me. So there's not a right or a wrong. There's not a good or a bad, but you do need to absolutely establish what you're comfortable with, because the last thing you ever want to be doing is looking at your account and sweating bullets. Oh, this is too much risk. Again, when the market's good, everybody's happy. When the market's bad, that's usually the indicator of where you really are with your risk tolerance. So be honest with yourself. And again, one thing I would talk about when I talk about risk, there's best practices out there. I've already talked about a couple. Another best practice I would tell you is if you can avoid losing money in the first 10 years of your retirement, your probability of success, you've heard me say that in past podcasts, but your probability of success is basically the concept of like, hey, what is your percentage or your opportunity to run out of money? If I said to you, hey, you're going to retire and you have a 30% chance of not running out of money, are you going in very confident? No. If I said, hey, you have a 96% chance of being successful in retirement, aka not running out of money, you're like, wow, this is good. I could retire any point in time I want. True, right? So we just got to understand that and be honest with ourselves, because when it comes to that conversation, there's not a right or a wrong. Educate yourself. And again, I've talked about this till I'm blue in the face. The income plan is a great way to identify what your required rate of return is. So that helps you make investment choices. So now let's kind of jump over to investment choices and investment options. This is a fun one, and I'm going to break it down into 3 categories. I'm going to make it, as short and sweet as I can, because I could probably talk about this for 2 hours. Let's start at the risks area. Historically, the most risky investment you can own is an individual stock or equity. Hey, I went and I bought my Amazon, my Tesla, my Apple, my Google, whatever. It's an individual company and it has a ticker. It's publicly traded on the New York Stock Exchange or the market. So you can look it up. It's all on one company. So that performance is going to ride or die on that one company. That is historically the most risky thing you can do because there's no diversification. It's all based on that one company's performance in a portion of time. So a stock is usually at the top of the line. Then we get into other investments such as, a mutual fund, ETF, which stands for Exchange Traded Fund. These are going to be groups of stocks that you are saying, hey, I trust Vanguard. I trust ProShares, that they have a group of financial professionals like myself, right, in different capacities, that are going to put together a group of stocks, group of companies. Maybe it's 10, maybe it's 20, maybe it's 50, maybe it's 100. And you can look that stuff up in the prospectus. What are the holdings of VUG, Vanguard Growth Fund, VOO, right? These are Vanguard's ones. I'm just leaning into them because everybody's pretty familiar with Vanguard. But you can look up the holdings of these ETFs and mutual funds to see what companies they're holding. And then you can also understand what level of risk they have. But the thought process is, hey, if this is all this group of people and this company does is pick groups of stocks that achieve certain goals, the odds are I'd say, hey, they probably have a better shot at me doing this for the 13, 15 minutes I look at it once a month or whatever that number is for you. So mutual funds, ETFs, they're still into the more, what I would say, and again, you can kind of get them all over the space here from an aggressive one to a conservative one, but usually those are made up of a bunch of different stocks and different companies. So those tend to be a little bit more risky. And again, you can get conservative ones, you can get dividend ones, and I go down a rabbit hole. Then let's keep moving here. Then we get into what I would call dividend payers. You can get a REIT, real estate investment trust. You can get a ETF or a mutual fund or an individual stock that pays you a dividend. What the dividend's going to be is I'll use AT&T. Up here in Michigan, personal story. My wife's grandmother had all AT&T. Okay, all AT&T. And the reason she did is because AT&T had been very, very good about paying their dividend. So she basically lived off the AT&T dividend every year, and that's all she needed. Her Social Security and the dividend from AT&T, she was getting paid monthly, right? So you want to look up a company, whether it's a stock, an ETF, a mutual fund, or a REIT. How often do they pay it? What's the percentage they've historically paid? Have they missed any dividends for one reason or another? These are the things you need to look at if you're looking at a dividend. Is it paying monthly, quarterly, annually? What's the percentage? You work that math backwards. Dividend payers are a great strategy in retirement. So for most families, it depends on your situation. But I like dividend payers, and that's a great way to look at things. Then you get into, areas such as, bonds. Again, we've already talked about bonds a little bit. In a rising interest rate environment, be wary and be understanding. Can this bond be affected by a rising interest rate? Because that's how you can lose money in a bond. The treasury, is it a treasury or is it a corporate? You want to look up, and if you're doing some research on this, you want to go and look up, hey, is it a junk bond? Is it a quality bond? Understand what type of bond it is, because that's going to help you identify, is it a good one or a bad one? Okay, because again, it's not if an investment is good or bad. The question is there anything better? And that should be the conversation you're having. Okay. Then you kind of get into the money markets, stable value funds, still in the market, still technically, in the exchange or a security, if you will. When you get into the stable value funds or a money market, usually they're going to give you a lower rate of return based on interest rate environment, with no to very minimal risk. Hey, I have a money market and it's similar to like the bank. Okay. Hey, I got a money market and they're paying me 5.2%. I don't pay any fees. The account's fully liquid. And I don't really have any risk. But if interest rates start dropping, I will not get 5.2. I might get 5 or 4.7, whatever the interest rate fluctuation is that does have subject to change based on interest rates. CDs. CDs and fixed annuities are very comparable to each other. I'll start with the CD because most people know CDs. Certificate of a deposit. That's going to be something that is more focused on, hey, 3 month, 6 month, 9 month, 1 year, 2 year, 3 year, 4 year, 5 year, whatever the term is. I usually don't go beyond a year to 2 years in CDs, sometimes 3 if the rate's really nice. But what it is, it's saying, hey, there's no risk unless you get a company that goes under or something. But again, that's very rare. With this, you go to a bank, you go to a credit union, and hey, I'm going to get a CD, and it's a 1 year at 5.4%. There's no risk, no fees. I just can't touch that money for 1 year, right? For that time or that duration. Term is another word we would use on that. What's the term on it? So a CD is almost identical to a fixed annuity. So, annuities I'm going to talk a little bit about today. I'll explain a fixed annuity, and then I'm going to kind of make my point with annuities as a whole. So a fixed annuity is the same thing as a CD, but you go through an insurance and annuity company. Hey, I just did one the other day, and again, based on rate changes, don't quote me here. Obviously, this stuff changes like the wind blows. A client sold their company, and they didn't want any risk with this money. So really, I was in a situation where I was like, all right, we're looking at money markets, we're looking at CDs, and we're looking at fixed annuities. I said, how long do you think until you need this money? And our income plan told us the answer, but I was going to verify. Hey, Alex, we don't need this money for at least 5 years. Okay. And you don't want any risk at all? No. Okay. Now, it made sense for their plan, but we ended up doing a 5-year fixed annuity. And on that, they got 6% fixed, no risk, no fees. And then that company would be paying my commission for setting that up. And I have to disclose all that. So what it worked out is I compared it to a 5-year CD. And at the time, the 5-year CD was paying something like 5.35, but the fixed annuity was getting 6%. No risk, no fees, comparable, boom. Now, you do need to do your history and do your research. That's part of my job or a financial planner or a professional's job to vet these companies. What's their rating? What's their financials? Are they a good standing company? And that stuff is 99.9% of the time that should be public on their website, easily accessible. And again, that's part of the process as a financial planner. So we ended up going with a fixed annuity over a CD because we got a better rate with the same darn chassis, if you will, right? No risk, no fee. So let me talk about annuities for a second, because oftentimes when I talk about investments, I will hear one of two things on annuities. People either love them or they hate them. There's 4 types of annuities. So usually when somebody's like, I hate annuities, not to say it's true or false, one of two things is usually what I've identified from experience, doing this long enough to be able to have this conversation and have an educated conversation. Number one, they either had themselves or a family member has had a bad experience with an annuity. Because I will be the first person to tell you, there are good ones and there are bad ones. The same thing as a stock. You know, if I told you this penny stock of a Greek shipping company that doesn't have a website is a stock and you can buy it on, publicly, is the same thing as Amazon, which is a stock, I'd be out of my mind, right? There's good and bad stocks. There's good and bad CDs. There's good and bad bonds. There's good and bad annuities. So when I go down the annuity path, really I try to break it down. There's 4 types of annuities that you need to understand. I'll start with the first one because I already mentioned it. A fixed annuity. It is basically the same concept and the base principles of a CD. So, hey, we have a fixed annuity. There's no risk. It's a certain time or duration, and they give you a fixed rate. Then I'm going to use the second one. I'm historically, and I'm not saying all are bad. That's not what I'm saying. Biased, fully biased opinion. I historically haven't been a huge fan of variable annuities, okay? And I can do pretty much any type of investment pertaining to securities or life, annuity, fixed, health, whatever. So variable annuities is historically where I've seen people have a bad experience because you got to keep this in mind. What annuities were 5, 10, 15, 20 years ago is much different than what they are today. I'll talk about that in a little bit, but the basics of it is, think about this. It's all about economy. It's all about the need for something. If I went back 5, 10 years, the annuity space, only about 17 to 20% of retirees were using annuities. Today, almost 47% of families are using annuities. So the market knows this. The insurance and annuity companies know this. So they're making these products more competitive. They're changing them to make them better. Not always, but again, I'm using kind of, big picture, big comprehensive numbers here. So you got the fixed annuity and you get the variables. This is the basics of a variable. Variables were created, back, in the 90s pretty much, where this is when they got popular, I should say. And Wall Street brokers, it was the first time they could give a guarantee. Hey, I guarantee you'll never lose more than 10%. And I can actually create a buffer or a floor on this investment. People said, I like the idea of that. So when they first put them out, hey, when the market goes up, you participate in it, but I can give you a -10 as a max, a -20 as a max on the downside. And people like that. So now you get these guys and gals out there selling a product, and you should never be selling a product, my opinion. It should be solving a problem or a fear or a concern that you have. It should never be a sales pitch. And if it feels that way, you should know that, and you should, that should land in your moral compass. So, the variable annuities, they got popular with the Wall Street guys being able to give kind of guarantees. And then what nobody really realized is they didn't look at the fine writing of the rider charges. So you have to be aware of riders if you're ever going to look at an annuity. What is a rider? A long-term care rider. I'm going to talk about this when I get into later chapters in more detail. Mortality and expense rider, income rider. Every time you hear the word rider, you need to verify if it has a fee attached to it. Because what people started figuring out real quick was they have this variable annuity. Hey, it's got a floor of 10 or 15 or 20 or whatever it is where you can't lose more than X. When the market's good, you make money, great. but then they didn't realize they were paying 3% in fees. That's pretty high. I've seen a variable annuity that somebody was paying over 4% in fees and they didn't even know it. So make sure you understand the fee relationship with that account, and you understand how much risk you have in that account. Because again, variable annuities, they have risk. You can lose money. They might put a floor on it, but you can lose. So variable annuities, again, I haven't been a big fan of them, and I'm not saying that's right or wrong, but you have to understand this. So you got fixed annuities, aka very similar to the concept of a CD. You have a variable annuity, which is market based. There's risk, and historically, not saying all, historically have higher fees. Then you have something called a fixed indexed annuity. And anytime you're talking about insurance products or annuities, break down the words. Fixed indexed annuity. It's fixed, which means that there's no risk to your principal. It's indexed. That's how it grows. What's an index? The S&P 500, the NASDAQ, the Dow Jones. So usually you're going to have a crediting index based on how that thing performs. You will make money when that index does well. S&P 500, that's one of my favorites to use. Everybody knows it. Historically, it's done pretty well. So you got your fixed index annuity, and then the last word in there, annuity, all that means is income. All the word annuity means is income. So I've used the fixed index annuity as a bond replacement. I've used it as an income play. It can be safe money for you. It just depends on the person and the family. Full transparency, fixed index annuities are probably my favorite of the bunch, because if I told you, hey, you got this investment where there's no risk, you don't have any fees, and again, it depends on the one, how they give you indexing, what the fixed rates are, and you could get somewhere between 4 to 6%. You'd say, hey, that sounds like a pretty good investment for safe money. You can't compare that to a stock. You can't compare a fixed index annuity to Apple. It's not the same thing, right? That's apples to oranges. So you have to recognize that. What else do you need to know about a fixed index annuity? Number one, they're going to be a term. It could be 5 years, 7 years, 10 years, 12 years. I've seen some 20 years, right? I think that's a little excessive. And then, hey, what's the free withdrawal amount? AKA, how much liquidity can I take out of this thing in a year? Usually you're going to see them around 10% a year. I've seen some at 7%. I've seen some at 5%. I've seen some at 0%. So understand the free withdrawal amount. That's how much you can take out. And then the last thing you want to understand with the fixed index annuity is caps and participation rate. I have a fixed index annuity. It's 10 years. I can take out 10% a year of liquidity of the principal and interest. And I have a S&P 500 cap of 10%. So if the S&P 500 goes up, I get the first 10%. Anything past that, I do not get. So that would be an example of a cap. They're going to give you a number, and you can't make more than that in an annual or 2-year or 3-year time frame. Again, that's the index and crediting. It could be 1, 2, or 3 years. I like the 1 years for the record. And then when we talk about participation rate, let's say I told you I had a par or participation rate on the S&P 500 of 70%. Market goes up 10%. You get 7. Why? You get 70% of the growth, participating in X% of the growth. If you had a participation rate of 20, probably not a great rate in my opinion, based on today, but that would mean if the market went up 10, you got 2, right? So understand when you're ever going to look at annuities, understand your fees, understand the term or how long the contract is, the duration, understand the participation rates, the caps, and the riders. If you can understand all those things, you can make a much better educated decision. If you have an annuity, I would highly encourage you to reach out to me. I can let you know where it lands. Hey, is this competitive? Is it not? Would I make any changes? If you have an annuity and you're not sure, and this is all kind of a foreign language to you, I would highly recommend you reach out to me because they can be confusing. The last type of annuity, deferred annuity. Pretty much, I'm not going to make this generalization, but I'd be willing to bet it, is if you're watching this or listening to this, you have one. You'd say, Alex, wait a minute, I don't have an annuity. Yes, you probably do if you have a Social Security benefit. If you have a pension, those are what we call deferred annuities. you paid in for a series of years and now they're paying you monthly or annual or whatever. That is what we would call a deferred annuity. So there's 4 types of annuities. They're all much different. So I can go deep down the rabbit hole and start talking about private placement and different types of investments. Those are kind of the primaries that I would talk about, along with understanding like your retirement target funds, small cap, mid cap, large cap, international. That's, again, kind of a deeper conversation. But if you have questions about what investment choices are going to make the best sense for you and what options make the best sense, again, reach out. I can go through that. This should be a conversation you're having with a financial professional. And again, it should be tailored to your specific needs, your risk tolerance, all those important things. So, this is a topic, whenever we're talking about the market investments, it changes like the wind blows. The most important thing I would talk about on this is understand where you're at. If you have a spouse, talk to your spouse, make sure you guys are comfortable with where you're at, but make sure you're educating yourself on what other options are available to you. Hey, it's not good or bad. It's, hey, are we in the best spot today? Because it changes like the wind blows. And I'm not saying you should be day trading. That's not what I'm saying. But I'm saying you should be making sure you understand, especially when you make the decision to retire. You got one shot at doing this correct. And make sure you spend a little bit extra time educating yourself to make an informed choice. Because when you move that needle to retirement, it is a much different picture. You don't have that monthly income, right? You don't have that safe fall. Now you're drawing on these accounts most of the time. So make sure you have a good education and standpoint of what your best choices are on the investments that are tailored to your family. So again, encourage you, reach out, set up a time to chat with me. Happy to do that. There's no cost to it. But irregardless, I don't care if it's me or somebody else, make sure you're educating yourself. Spend that time. And again, it's a very big decision. Make sure you understand. So hopefully this was good. This is a complex one. I tried to stay, high up as I could. Next week, or I should say next time you tune in, we'll be covering chapter 8, which is going to be another great subject. So hopefully you enjoyed it. Again, joining me here, 10 Fears of Retirement. And I'm enjoying this. I hope you're enjoying it. Please make sure you're following us, getting these updates. Please sign up for the book if you haven't got it. And again, if you'd like to take time to meet with me and go through a process, I'd love to do that for you and give you a little bit more clarity on your situation. But we'll see you next time when we jump into Chapter 8, 10 Fears of Retirement. Have a great rest of your day and God bless you.